Dear investors, I'm Gunawan Sutanto, Head of Research, Phillip Securities Indonesia. Today I'm going to share with you about our view on Indonesia macro outlook for this year, as well as estimates for the Jakarta Composite Index and what will be the key drivers for the market. Shares listed in the JCI have recently been more attractive price to book wise than on price to earnings basis. This is largely due to weak earnings results in the past few quarters amidst declining commodity prices and weak rupiah exchange rate. But at the same time, strength in listed companies' balance sheets have, in general, mitigated the impact of low commodity prices and weak rupiah. As such, we think it is still a good time to accumulate stocks of companies with strong financials. From top-down view, the major drivers for Indonesian market this year will be infrastructure spending, in which the government plans to spend more than 5,500 trillion rupiah from 2015 to 2019, potential further interest rate cuts by the Central Bank Bank Indonesia, and expansionary fiscal policies in the forms of tax cuts, rebates, and increased government spendings. With the government's decision to cut fuel subsidies since 2015, more budget is expected to be allocated for infrastructure projects. Compared to 2014, when the government spent almost 19% of its budget for fuel subsidies, 2015 and 2016 will see a significant decrease in fuel subsidies and increase in infrastructure spending to an estimated 14 to 15% of state budget. The majority of the spending is planned to be spent on power generation with a set target of 35k megawatts in total. Electrification ratio is targeted at 96.6% by 2019 from currently about 80 to 85%. Other areas of development include new roads and new toll roads, seaports and water pipelines, and lower income housing projects as well as national internet coverage. Our in-house economists estimate inflation to stand at about 4 to 5% in 2016, with the rupiah anticipated at between 14,000 to 15,000 for a dollar. With more room for rate cuts amidst lower inflation rate, we anticipate Bank Indonesia to trim benchmark rate by at least another 50 to 100 basis points this year to the median of 6% from record high of 7.75% last year and the most recent rate of 6.75%. We surmised three scenarios for the Jakarta Composite Index in 2016 and lean more onto the strong case of 5,300 index level at the end of the year, with EPS growth estimates of 15%. This expectation is quite realistic, given the 20% average annual EPS growth rate in the past 10 years. The strong case will be supported primarily by infrastructure spending and lowered benchmark rate. On the downside, strong US dollar could remain a dragging factor to listed companies' earnings. Thank you for watching and stay tuned for more of Phillip Capital's research videos.